Almost everyone who tries to learn Forex fundamentals ends up more confused than when they started. You hear terms like inflation, interest rates, GDP, and central banks, but nobody really explains how these things actually connect to currency movements. So traders go back to charts because at least charts look concrete, but the reality is that Forex fundamentals are not complicated. They're actually very logical once you see how the pieces fit together. And once you understand these drivers, currencies stop feeling random and start making sense. This is where most traders get stuck. They learn technical analysis first, and fundamentals feel abstract and disconnected. But currencies are not just numbers on a screen, they represent entire economies. When a currency strengthens, it's usually because investors want exposure to that economy. When a currency weakens, it's usually because capital is moving elsewhere, and those decisions are driven by a handful of key macroeconomic forces. The first and most important driver is interest rates. Interest rates determine the return investors can earn on capital. If one country offers higher interest rates than another, global investors have a strong incentive to move money there. Investors buying bonds or other financial assets need the local currency, and that demand pushes the currency higher. This is why interest rate cycles create some of the biggest moves in Forex markets. When a central bank begins raising interest rates, expectations of higher returns attract capital. Investors anticipate these changes months in advance, and currencies often strengthen long before the first rate increase happens. But here's the part most traders miss. Markets don't move based on today's interest rates. They move based on expectations about where interest rates are going. If traders believe rates will rise, currencies often strengthen even before policy changes occur. If traders expect rate cuts, currencies often weaken before the cuts actually happen. Once you understand that expectations drive markets, a lot of confusing price movements suddenly make sense. A central bank can raise interest rates and the currency can fall because the market expected even more tightening. The expectation changed and the currency adjusted. Interest rates form the foundation of Forex fundamentals, but they are not the only driver. Economic growth plays a major role as well. Strong economies tend to attract investment, businesses expand, employment rises, and consumption increases. Investors want exposure to economies that are growing because growth creates opportunities for returns. When investors believe one economy will grow faster than another, capital tends to flow toward the stronger economy. This demand strengthens the currency. When growth slows, capital often moves elsewhere. This is why economic data matters. Reports like GDP growth, manufacturing surveys, and employment numbers provide clues about economic momentum. Institutional traders analyze these indicators to understand whether an economy is strengthening or weakening over time. Inflation is another key piece of the puzzle. Inflation measures how quickly prices are rising in an economy. Moderate inflation often signals a growing economy, but high inflation can force central banks to tighten policy. Higher interest rates can support a currency if they attract investment. But inflation is not always positive for a currency. If inflation rises too quickly and reduces purchasing power, confidence can fall and investors may move capital elsewhere. The impact of inflation depends on how it influences policy expectations and economic stability. And then there is employment, which provides insight into the health of an economy. Strong labor markets usually support consumption and growth. Rising unemployment often signals economic weakness. Central banks pay close attention to employment conditions when making policy decisions, which means employment data can influence interest rate expectations and currency movements. Now this is where the bigger picture starts to come together. Interest rates, growth, inflation, and employment are all connected. Strong growth can push inflation higher. Rising inflation can lead to higher interest rates. Higher interest rates can attract capital. These relationships create the macro trends that drive currencies. And this is why Forex fundamentals are actually simpler than they appear. Instead of analyzing hundreds of indicators, professional traders focus on a handful of key drivers and how they interact. The goal is not to predict every data release. The goal is to understand the direction of the macro environment. Another major factor is global risk sentiment. This is something traders often underestimate. When markets feel stable and confident, investors tend to move capital toward higher return assets and growth-oriented economies. When uncertainty rises, investors often shift capital towards safer assets and more stable currencies. These shifts can drive major currency movements even when economic data remains stable. Risk sentiment affects multiple currencies simultaneously, creating broad trends across the Forex market. And this is the breakthrough moment for many traders. Forex fundamentals are not about memorizing economic indicators. They are about understanding the forces that drive capital flows. Once you focus on capital flows, currencies begin to make sense. This is also why currency strength is such a powerful concept. Instead of analyzing currencies in isolation, professional traders compare economies. If one economy is strengthening while another is weakening, that divergence creates directional pressure in the currency pair. These divergences often produce the strongest trends in Forex markets. Interest rate expectations diverge, growth outlooks diverge, risk exposure diverges, capital flows respond accordingly. Once traders adopt this relative approach, the market becomes clearer. Instead of asking whether a currency is strong or weak in absolute terms, the question becomes which currency is stronger relative to another. This comparison is what determines direction in a currency pair. This structured approach to fundamentals is exactly what MacroDrivers is designed to provide. Instead of trying to gather information from dozens of different sources, the platform tracks the major macro forces driving currencies, currency strength across economies, changes in macro trends, shifts in the global risk environment. The goal is not to overwhelm traders with data. The goal is to provide a clear macro framework that reflects how professional traders analyze markets. What's interesting is that once traders begin using a macro framework, Forex becomes easier to interpret. Price movements feel less random, trends become more understandable, decisions become more structured, charts still matter, but their role becomes clearer. Technical analysis helps refine entries and manage risk, while macro analysis provides direction. This combination allows traders to operate with a structured approach rather than guesswork. And once you understand Forex fundamentals properly, trading changes. So you're no longer reacting to every move. You're analyzing the environment that creates those moves. That shift alone can transform the way you approach markets. If you're serious about trading Forex professionally, fundamentals are the foundation. That's exactly why MacroDrivers exists, to track currency strength, macro trends, and global risk conditions in a structured way that reflects how professional traders analyze the market. Because once you understand Forex fundamentals properly, currencies stop feeling unpredictable and start feeling logical. And when markets become logical, opportunities become much easier to see.